While you've probably heard me suggest that you should treat your property investments like a business, in today's podcast I'm going to explain to you the different property investment games that people are playing and how you must be aware of taking advice from people playing a different game than you are. Now, what do I mean by a different investment game? That's what I'm going to explain to you. I'm also going to share with you what makes an investment-grade property, and here's a spoiler alert. What makes a great investment for me probably won't be a good investment for you. Now, if you're a regular listener, you know I usually have a guest on these shows, but today's topic is so important, I just wanted to have a personal chat. Just me and you. And today's show is a little longer than usual. We'll spend about 45 minutes together. But at the end of the show, I hope you're going to have discovered some valuable insights and tips for crafting your own personalised investment strategy. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
As a seasoned property investor, I've witnessed firsthand the intricate dance of property markets. Over the years, I've come to appreciate that property investment, it's a complex affair. And despite all the podcasts, despite all the blogs, the webinars, and so many, well, let's call them so-called advisors, the fact is that most investors fail to achieve the financial freedom they're looking for. I've also learned that the various market participants are playing a wide range of games, each of them with their own unique goals, their own unique attitudes, time frames, risk profiles and incentives. And one of the reasons most investors never get past their first or second property, one of the reasons most investors fail to develop the financial freedom they're looking for, is they haven't figured out what game they are playing. Now, look, they may have a vague idea of their game, but they haven't clearly defined it. And when they don't know what game they're playing, they're at risk of taking their cues, taking their advice from people playing a different game, which leads to risks they didn't intend and outcomes they didn't imagine. Look, the fact is, the Australian property market's a fascinating stage where there are multiple players coming together, each with their own unique approach to investing. Now, these players include first home buyers. They've got a very, very different game they're playing to beginning investors, who again are playing a different game to experienced investors who've already got some properties under their belt. And then there's property developers, real estate agents, property marketers, spruikers, and many other people. And each of these participants have got their own goals, motivations, strategies, and timeframes, making, as I said at the beginning, the property market an interesting dance of various investment styles. And if you think about it, the type of property that makes a great investment for me at my age, and I'm almost certainly much older than you, and I've got a very substantial and a very diversified property portfolio under my belt, the type of investment that makes a great investment for me would not be considered a great investment for somebody at the beginning of their investment journey. In fact, the sort of properties I'm buying, I'm building, I'm developing today is very different from what I did 20 years ago. Yet there are many marketers out there, buyer's agents out there, so-called strategists and advisors out there who just happen to have that one ideal strategy for anyone who approaches them, or that perfect property just for you, just like it is for the other 100 people buying in the same high-rise apartment building or that new house and land area. So let me be clear. There's no such thing as a one-size-fits-all property strategy. Or there isn't an ideal investment to suit everybody. Instead of treating property investing as a singular game, we should view it as a collection of games, each with their own objectives and skills. For example, a beginning property investor who wants to build a substantial property portfolio over the long term, one that's eventually going to give them financial freedom and choices in life, in my mind should be investing for capital growth. Because if they don't, they won't be able to get the next property, they won't be able to build a portfolio of properties, and one property is not going to get them where they want to be. The problem is many beginning investors play the wrong game, and they invest for cash flow. And while cash flow is important, and sure it keeps you in the game, buying the wrong type of property means that these investors will never build a portfolio of sufficient size to give them financial independence. You just can't buy your next property and the next one out of cash flow from your rents. You need capital growth. You need asset appreciation to get the next deposit, and you need the rising rents from a capital growth property, from a rising value property, the rising rents to help pay for your mortgages. Now, the Australian Tax Office statistics clearly shows that 92% of investors never get past their first or second property. And as I said, this just isn't enough to give you sufficient cash flow to live off. What I'm getting at is that beginning investors should be playing a different game to those who've already got a substantial property portfolio, or those who are at the next stage of their investment journey, where maybe they're starting to lower their loan-to-value ratios. These investors should be playing a game and maybe considering adding commercial properties to their portfolio, not at the beginning, but at the end stage of their property growth journey. And those investors nearing retirement should be playing a different game again, investing in other assets, not taking on too much debt so that in retirement they've got cash flow. So I'm not suggesting property is the only investment class. As I said, those nearing retirement should be looking at cash flow investments as well. So to achieve success in this ever-evolving landscape of real estate, one must acknowledge this diversity that I'm discussing, and you've really got to adapt your own investment strategies accordingly. Yet many blogs, podcasts, advisors, they lump everyone into the same category. They call them investors, and doing this inadvertently sets them up for failure. In my mind, it's essential to recognise that each investor's got their own unique set of circumstances, their own priorities, their own goals, which means the best course of action for one person may not be, in fact, isn't suitable for another. And by appreciating the complexity of the property markets, you can avoid the common trap trying to force a one-size-fits-all strategy into your investments. And that's why at Metropole, my team, even before discussing the next property, we build each client a personalised, customised strategic property plan. We take into account their distinct goals, their motivations, their timeframes, their risk profile. As I said, there's not one size fits all. We recognise each investor's got their own unique set of circumstances, priorities, goals. That means the best course of action for one person may not be suitable for another. And I guess you know by now that at Metropole we've got no properties for sale, but we've got access to time-tested frameworks that I've personally fine-tuned over 5 decades, and with which we've helped clients outperform the market averages for over 20 years by taking into account detailed research, and then we build a flexible investment plan that accounts for the ever-changing dynamics of the property landscape. You see, property investment isn't like sport. In sports like, golf, rugby, soccer, players all around the world, not just in Australia, adhere to a specific set of rules, ensuring everyone plays the same game. However, investing's a completely different playing field. As I've explained, different market participants play different games. And embracing the diversity of investment strategies, it's essential for a healthy market. It means there's always going to be somebody who thinks it's the right time to buy, when others think it's a good time to sell. That's what creates markets, isn't it? Of course, recognising that other investors have got different priorities, and other participants, but not just investors, and 70% of the market's made of homeowners. So recognising that these people have got different priorities can help you maintain an open mind and stop you falling into the trap of thinking that your approach is the only right one. Look, while it's essential to define your game, it's important to stick to it. It's also crucial to be adaptable to change as the market changes and as your personal circumstances change. And that's why I believe it's important to regularly review your portfolio. It's actually hard to do on your own, and that's what we do at Metropole. We review our clients' portfolio. We'd love to do it for you as well. You can always contact my team at metropole.com.au. And I think it's important to reassess your strategy to make sure it's still appropriate. Is it appropriate for the changing times, the changing markets, or where you are in your stage of your property journey? Because as you learn, as you grow, your investment game is going to evolve. So you're going to have to align your strategies with your changing goals and risk tolerance. So I actually don't own any of the properties I bought 50 years ago, 40 years ago, 30 years ago. That's not totally true. I still own my first property, but it's not the old house that was there. I built 2 townhouses on there. Oh, look, I've made more than my share of mistakes. You've probably heard me say before that I'm a real success at failure. In my early investment career, in the late 1970s, I bought 2 factories in Dandenong Street, Dandenong, an industrial hub in Melbourne. They were well leased to a furniture manufacturer. I got great regular rents. But I had minimal capital growth because capital growth was capped to the increasing rents, and that's the way commercial properties are valued. And at that stage, and in fact most commercial leases now, the rents pegged at around 3% per annum rental growth. Now, I bought these factories because I thought commercial real estate was the way the big boys played, and I wanted to play that same game as well. I bought them too early in my career, and the lack of capital growth hindered me moving forward and stopped me buying more properties. Look, I eventually sold those properties and I used the funds to buy high-growth residential properties, which allowed me to buy even more properties, and the increasing rent allowed me to fund my mortgages. I guess I just didn't know what game I was meant to be playing at that stage in my investment career. Now, I today have a very substantial commercial property portfolio, but it's appropriate for where I am, the stage I am in my investment career. So some people would then ask, well, what makes an investment grade property? What sort of property should I buy? Now, there are about 10.9 million dwellings around Australia, and the total value of all these properties is approaching $9.5 trillion. And at any time, there are hundreds of thousands of properties for sale around Australia. And now that the markets are moving into the next phase of the property cycle, strategic investors are back in the market, actively purchasing properties, knowing the market's going to reset and a new cycle is going to begin later this year. But here's a word of caution. Don't rush out and just buy any property, because not all properties make good investments. In fact, in my mind, less than 4% of the properties on the market currently are what I'd call investment grade. You see, currently there are fewer properties on the market than long-term averages. There's not many properties for sale, and that's one of the things that's underpinned our property markets. And while there are still many properties on offer, there's a real shortage of what I call A-grade homes or quality investment-grade properties. Now, of course, any property can become an investment. You just move the owner out, put a tenant in, it's an investment. But that doesn't make it investment grade. Tell you what I consider investment grade property, let's first look at the characteristics of any great investment, not just property, and then let's see what type of properties fit into these criteria. The things I look for in any investment, including property, are strong, stable rates of capital appreciation. Number 2, I look for strong cash flow. 3, I actually look for liquidity, the ability to take my money out by either selling or borrowing against my investment. I look for easy management. I definitely want to hedge against inflation, and I look for good tax benefits. So how do you make your money from property as an investment? Well, in my mind, property investors make money in 4 ways. Number 1, through capital growth. The property appreciates in value over time. Number 2, through rental return, the cash flow you get from your tenant. The third way you can make money from a property investment is accelerated or forced growth. This is the capital growth you manufacture by adding value through renovations or development. And then the other way you make money through investments is through tax benefits, things like negative gearing or depreciation allowance. But be careful. Not all these returns are equal. They're not created equal. Capital growth isn't taxed, while rental returns are. And as your property increases in value, the rent increases, and that also generates more cash flow, meaning capital growth is much more important as a driver of your wealth creation than cash flow. Now, I know not everyone agrees with that. But then, remember, if you do what everyone else does, if you do what 92% of investors do, you're going to find that you won't ever build the substantial property portfolio you're looking for. Now, clearly you need cash flow. You need to be able to hold on to your property portfolio for long enough so that the power of compounding of capital growth kicks into gear, meaning you have to have a financial buffer to see you through the lean times. Having the right finance strategies is an important part of capital growth, of being able to just stay in the market for capital growth. This means you need to be careful about your cash flow. You have to be able to service your debts. Too many investors don't recognise that property investment is a game of finance. And sure, it's got some houses thrown in the middle, and they've left themselves open to financial woes by not having a rainy day buffer of money that they can draw on when they need. And sometimes this means that they end up selling at the wrong time in the cycle. Times they shouldn't be selling. So, as I said, cash flow keeps you in the game, but it's really capital growth that gets you out of the rat race in the long term. So I hope the message you're getting from this one-on-one chat with me today is you can't afford to do what most investors do. As I said, statistics show that most property investors fail. They never achieve the financial freedom they want to. And it's in part because they're following the wrong strategy. And for many of them, they're actually investing for cash flow. They're chasing cash flow. They're playing the wrong game, as I said right at the beginning. I guess putting all this together, it means the property investment may be simple, but it's not easy. Now, I say this because clearly most property investors actually fail to get that substantial income they want to get to retirement. Those who are looking for cash flow, thinking about the here and now rather than the long term. I mean, they're buying properties to solve a short-term problem, but this won't give them the long-term results they're hoping for. That only comes from building a substantial asset base. I'm sorry I'm going on about this, and I've said it a few times, but it's the biggest mistake I see particularly beginning investors make. Now, I know that a lot of the listeners to my podcast are experienced investors, and you know this. So thank you for allowing me to repeat myself. And yes, I do understand why many investors are looking for cash flow. In general, they're looking for more choices in their life. They're often looking for a choice of whether they're going to work or not because they have to, but because they want to. But in my mind, these investors need to build a substantial asset base of investment-grade properties and other assets, and then they can buy the cash flow, maybe by lowering their loan-to-value ratios, maybe by adding commercial properties to their portfolio, maybe by adding some shares, which are great dividend and tax-effective. But investment must be done in the right order. Asset growth first, then cash flow. Now, of course, the number of investment properties you own isn't nearly as important as the quality of your assets and the amount of equity that you've got on them. Look, I've often said I'd prefer to own one Westfield shopping centre than 50 properties in regional Australia. I know that's an extreme. But again, looking at the statistics shows that most investors don't get there. But when I examine the tax office statistics, it made me wonder how our clients at Metropole have performed. Those who've been given strategic advice to guide their investing, how their properties performed and how their portfolios performed. Currently, Metropole manages close to $2 billion worth of property assets on behalf of our clients. So what we're able to do was see how many clients owned 1, 2, 3, 6 more properties. And what we've found is that our clients are 7.3 times more likely to be in the top 1% of investors who own 6 or more properties. So they've learned that capital growth is the most important factor of all. I've already explained my thoughts on this. And yes, I know there are other people who are going to tell you about cash flow. And remember, I said right at the beginning of our chat today that there are different games and different people have to play different games because of their own circumstances. But while cash flow is the ultimate end goal, you should only turn to cash flow once you've built a substantial asset base. Because in my mind, property investments comprises the journey you're going to have is going to comprise of 5 stages. Number 1, the education stage. You've got to learn what property investment is all about. But you've actually got to be careful. You should take advice from people who are playing the same game as you, not others who've got a vested interest. So it starts with the education stage. Then you go to the saving stage. You spend less than you earn, trap this extra cash flow in a savings account or wherever, build up a deposit to invest. Then it's the asset accumulation stage, and it's going to take 2 or 3 property cycles to build a sufficiently large asset base of income-producing properties to move to the next stage, which is where you lower your loan-to-value ratios. Now, I know people will tell you there are shortcuts. Shortcuts come with risks. Can you afford to take those shortcuts? But once you've got a substantial asset base, then you can lower your loan-to-value ratios, and then eventually you can live off your cash flow. The safest way through this journey, and as I said, it's obviously going to take a number of property cycles, despite what some of those podcasts and blogs are telling you that you can buy 10 properties in 10 years or 8 properties in 8 minutes or bypass the banks. No, you can't. By the way, there's no Easter Bunny or Father Christmas either. The best way, safest way to get through this journey is to ensure you only buy properties that are going to outperform the market with regards to capital growth. Now, of course, we've just come out of a property downturn, and we're entering the next stage of the property cycle where property values are going to go up, but the growth is going to be subdued for a year or two. But remember, it's a long-term game and take a long-term perspective. So I have a six-stranded strategic approach to my investing to make sure my properties outperform. Firstly, I'd only buy a property that would appeal to owner-occupiers. Not that I plan to sell the property, but because owner-occupiers will buy similar properties in the area, pushing up local values. Remember, 70% of property owners around Australia are owner-occupiers. So it's going to be particularly important in the next little while as the percentage of investors is on the low side. I buy properties below their intrinsic value. This is my six-stranded strategic approach. The second strand is buying below intrinsic value. That's why I avoid new or off-the-plan properties which come at a premium. It comes with developers' margin, marketers' costs. It's not intrinsic value. I buy properties with a high land to asset ratio. Now, that doesn't mean you need a large block of land, but one where the land component makes a significant part of the asset value. And I buy in areas where there's a long, strong history of capital growth. I'm not looking for the next hotspot. I'm looking for areas that are going to continuously outperform the averages because of the demographics in the area. And I particularly like investing in suburbs which are gentrifying. I look for a property with a twist, something unique, something special, something different, something scarce about the property. And lastly, I look for properties where I can manufacture growth through, well, in my case, redevelopment. I do a lot of townhouse development, but for beginning investors through refurbishment or renovation. So rather than waiting for the market to do the heavy lifting, I'd be buying a property where I can manufacture capital growth. Now, back to my original comment, not all properties are investment grade. Of course, there's plenty of investment stock out there, but don't confuse the two. These are properties that have been built specifically for the investor market. Think of those many high-rise developments that are littering our cities. Yet most of them are not investment grade. They're what property marketers and developers sell in bulk to naive investors, often off the plan. But as I said, they're not investment grade because they've got little owner-occupier appeal. They lack scarcity. They're usually bought at a premium, and there's no opportunity to add value. Off the plan apartments, new apartments in high, big towers just make terrible investments. And the studies show, independent studies show, that most people who bought off-the-plan properties haven't had much capital growth for quite a long time. On the other hand, strategic investors buy investment-grade properties that appeal to a wide range of owner-occupiers. Not that they ever want to sell, but it's nice to have that backup there, that are in the right location. And I don't just mean the right suburb, one with multiple drivers of capital growth. You know, there's short walking distance to lifestyle amenities, cafes, shops. We've talked about the 20-minute neighbourhood in previous podcasts before. They buy properties that got street appeal, that are favourable to look at. Nice aspect, good views. Investment-grade properties offer security, not just being in the right suburb, but also with gates, intercoms, alarms. Off-street parking is important in most suburbs. Now, I know in some of the inner suburbs you can't get off-street parking, particularly in Sydney and Melbourne, and I accept that. But in general, security has become more and more a factor that homeowners and tenants are looking for. So the bottom line is buying the right investment-grade property is all about following a proven blueprint, one that successful investors have followed. This increases your chance of better financial returns, and it reduces your risk of getting caught out when the property markets move stages, because we've just been through a downturn stage, but the cycle will repeat itself. And let me be clear, not all suburbs, not all locations are created equal. A short while ago, I did a podcast with Brett Warren about investment-grade locations. If you don't already follow this podcast or subscribe to it, as some people call it, and you're finding this information valuable, please click the little button on whatever podcast app you're listening to and follow this so you keep getting future podcasts. Now, this is a monologue with me, but usually I have guests, and in my podcast with Brett Warren, we discussed why some locations are better investment grade locations than others. If you download the last couple of episodes, you'll find it there. Because it's not just about the property, it's also about location. In fact, you'll have heard me say, as we chatted with Brett, that I believe location is going to do about 80% of the heavy lifting of your property's capital growth. And in this new COVID normal world, people love the thought that most of the things that they need for a good life are within 20 minutes of, whether it's a public transport trip, bike ride, walk from home, things such as shopping, business services, education, community facilities, recreation, sporting facilities, and some jobs. But there's nothing new about this. The rise of the 20-minute neighbourhood started long before COVID. However, now, the ability to work, live and play all within 20 minutes reach of these great facilities is the new gold standard of desirable lifestyle in our capital cities. Some suburbs are always going to be more popular than others. Some areas will always have more scarcity than others. And over time, some land will increase in value more than others. That's why it's important to buy your investment property in a suburb that's dominated by homeowners rather than the suburbs where tenants predominate. And you'll find suburbs where the more affluent owners live will outperform the cheaper outer suburbs, where wage growth is likely to stagnate moving forward, and where inflation is hurting people more, and where a lot of people are living paycheck to paycheck, not that we get checks anymore, but payday to payday, I guess, and where people have borrowed to the hilt to get in. And that's great that they got in the property market, but they actually are living with very little savings buffer. But it's the same all over the world. Go to any major city, London, Paris, Vienna, Los Angeles, and you'll find the wealthy people tend to live 10 to 15 minutes drive from the CBD, or they live near the water. Why is this so? Well, as a cynic, you'd probably say because they can afford to. And that's partly true. But in general, the more established suburbs where there's better infrastructure, shopping and amenities tend to be closer to the CBD. Now, I recently did a podcast with Ross Elliott. You can go back and listen to it. It came out in the beginning of April, where studies that his organisation did showed that there's a great divide, and the wealthy people have got much better infrastructure close to the CBD than the outer suburbs. And so there are always people who are going to want to and be prepared to pay a premium to live there. As I said before, the rich don't like to commute. So when you're researching suburbs, focus on those overlooked owner-occupiers who are going to give stability to a suburb. You see, in those more affluent inner-ring suburbs, half the people don't even have a mortgage, even more, because they bought their properties 30, 40 years ago. Then there are going to be people who bought their properties 10, 15 years ago who've got a 50% loan-to-value ratio. And sure, there'll be people who bought last year and the year before who've got high mortgages, high loan-to-value ratios. But that diversity gives resilience to the suburb compared to the outer suburbs where all the young people have overcommitted themselves to get in. So remember, 2/3 of our markets, our property markets, are homeowners. And that hasn't changed a lot over the years. And so in my mind, it's interesting that while owner-occupiers are one of the most significant influences on property, they're commonly overlooked by investors. Think about it. With almost 70% of all homes owner-occupied, this underpins the steady long-term growth of our property values. On the other hand, investors who comprise just 30% of the market, they create their own property booms and busts. They're driven by fear and greed, FOMO, and they create the downturns when they exit the market, as they did over the last couple of years, sitting on the sidelines or selling up. That creates volatility, while owner-occupier influenced suburbs are more stable. That's why I always give the following advice to investors who are searching for strong property performance. Buy the type of property that's going to appeal to owner-occupiers. Hey, I know I've said it a couple of times, but as I've already explained, in my mind, investment-grade property must have owner-occupier appeal, because that will also give a tenant appeal. So, thank you for taking the time to listen to me. Let me finish off by asking, what is your investment strategy? As I've said before, most start with a property, and that's actually the wrong way around. But just to make things clear, buying an investment property is not a strategy. It's important to start with the end game in mind and understand what you need and what you want to achieve. And then you've got to build a plan, a strategy to get there. The property you eventually buy will be the physical manifestation of a whole lot of decisions that you make, and they must be made in the right order. Now, of course, that's not the way most investors do things. Remember, right at the beginning, I told you they're playing the wrong game. They don't know which game they're playing on. They don't know the rules of their game. But property investment's a process, not an event. The problem is most people become property investors without putting much thought into it. Some upgrade their homes and turn their old homes into an investment. However, that doesn't actually mean it's going to be a good investment, because they probably bought it for emotional reasons rather than objective reasons. Others buy off the plan based on promises made by marketers, while others buy a property in their comfort zone, close to where they live. Isn't that how many beginners buy? Now, don't make the mistake many investors make and buy in your own backyard. Just because you're familiar with the location, that's not really a good reason to buy there. I wasn't surprised when I read a recent university study that showed that investors who bought a property close to where they lived tended to buy underperforming properties and didn't even get a price advantage on their purchase. Let me say that again. Despite intuitively thinking that because you bought in the suburbs you're familiar with, you'd have a good understanding. It was a study run by 2 Australian universities looking at the result of people who bought in their own backyard, and they bought properties that underperformed and didn't even get a bargain. Anyway, I guess you've heard it before. Failing to plan is planning to fail. On the other hand, strategic investors devise a strategy. They have a plan. They bring their future into the present and devise a plan to achieve the results they want. So your end game may look something like this. You're going to eventually own a home with no debt against it. I'd like to see you have a substantial asset base of investment-grade residential real estate with a level of gearing against it when you go into retirement. You don't have to get rid of all your debt. It may be nice to have some commercial properties that bring cash flow in, as well as some other income-producing assets such as shares or managed funds. Maybe there'll be a new super fund. I don't know. This is not investment advice. But when we devise a plan for our clients at Metropole, this is the way it sort of looks, having a mixture of growth and income assets and a conservative level of debt when they finish working means they're going to be able to live off the cash machine of their investments. Now, how big an asset base you're going to need, how long it's going to take to accumulate, how much cash it'll spin out will depend upon a myriad of factors. I can't tell you, but that's why I always start with looking at this and putting a strategic plan together. Getting wealthy, being successful in property doesn't just happen. It's a result of a well-executed plan. And the plan actually has a number of specific aims. It helps define your goals. See whether they're realistic, because boy, do we see people with unrealistic goals in either how much cash they're going to get from their property portfolio or how quickly they can accumulate a substantial asset base. A plan should also give you a way of measuring your progress towards a specific goal and actually having a look whether your current property portfolio is even working for you or if you're working for it. And it should have ways of maximising your wealth creation through property. Another really important part of the plan is identifying risks. The real benefit means you're going to be able to grow your wealth through your property faster and safer than the average investor. And at Metropole, our strategic property plans contain a number of components: an asset accumulation strategy, a manufacturing capital growth strategy, a rental growth strategy, an asset protection and tax minimisation strategy. You've often heard Ken Race on these podcasts. That's the area that he specialises in. A finance strategy, but not just to buy properties, but to get long-term debt reduction and a living off portfolio strategy. So what I'm saying is you should start with a strategy and then look for a property, because then you'll know which game you're playing. Remember when I started this whole long chat over half an hour ago with you? We talked about playing the right game. What's worse than having no strategy? Actually following the wrong one. And that's where we see, as I said at the beginning, people chase cash flow or look for the next hotspot, recipes for disaster, or chase tax benefits, buying a new house in the outer suburbs, or putting a deposit down an off-the-plan property. Almost as bad as not having a strategy is changing strategies because the world is changing as well. Rather than looking what's always worked over the long term, a lot of investors are looking for what works now. It's no surprise that their smiles turn into a frown when they buy an inferior property down the line. But currently I see a window of opportunity for property investors with a long-term focus. And this window of opportunity isn't because properties are cheaper than they were a year or so ago, but they are. But I think when you look back at buying a property today, you're going to think, hey, gee, that property I paid for, it's cheap compared to what I'd be able to get today. And that's arising because currently still consumer confidence is low. And many prospective home buyers and investors, they're still sitting on the sidelines waiting for firm confirmation that the property markets have bottomed. However, I believe later this year, or early next year, they're going to realise that interest rates have peaked. Inflation's peaked. The Reserve Bank's got everything under control, and interest rates are going to slowly start to go down. And when that happens, there's going to be a whole lot of pent-up demand released. You know, that old thing, FOMO, fear is going to overtake greed, as it always does at this stage of the property cycle. If you've been following the cycle for a while, we saw the same opportunity in late 2018, early 2019, when fear of an upcoming federal election stopped buyers entering the market. Look what happened to property since. I saw similar opportunities in 2020 at the beginning of COVID when people suddenly panicked, and look what happened. We had a once-in-a-generation property boom. I saw similar opportunities then in the global financial crisis and in 2002 after the tech wreck. History's got a way of repeating itself. Strategic investors will take advantage of these opportunities in our property markets, and they're going to look back and think, gee, I'm glad I made those decisions, because this is the time of the cycle when fortunes have been made in the past, but you've got to do it correctly. You've got to maximize your upside, but in the meantime, protect your downside. So maybe a couple of thoughts just to finish off our chat today. There's not one right way to invest, not one optimal strategy, not one universal goal. Different investors have different time horizons, different risk preferences, income levels, personal values, emotional biases, and expectations. They all face different constraints, opportunities, challenges in their lives and the markets. Therefore, they're playing different games with money. So my message to you is figure out the game that you're playing and stick to it. Clearly define your investing game, focus on playing it, and be cautious of getting advice from those playing a different game or seeing them on Instagram or Facebook or whatever, and don't be surprised that other people are playing a different game. That's what creates the markets. But as a property investor, understanding your game, staying true to it, will empower you to navigate the complex world of investing with more clarity and more confidence. And by acknowledging there isn't a one-size-fits-all, you're going to be much better equipped to make informed decisions that align with your unique goals and circumstances. Now, I know I went on a bit longer than the normal show today, and it was only me, but I hope you got benefit from it, because my aim is to show you that if you understand the right game, there's no reason why you shouldn't similarly be a successful property investor. So I'll be back again real soon. But let's move on to my quick mindset moment before we finish today's show. And if you enjoyed it, if you got some benefit from it, why not follow the show? Click on the subscribe or follow button depending upon which podcast app you're listening to, because twice a week I'm going to keep bringing you information like this, usually with some great guests.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I'd like to tell you that you've won the lottery. You see, there's roughly 7.7 billion people in the world today. Now imagine that there was a world's biggest lottery in which every one of us was required to draw a ticket, and that's going to give us the circumstances how we're going to be living for the rest of our lives. It would decide whether you're male or female, where you'd be born, the type of government that would be there, the country that would be, your parents' income level, your parents' occupation. It would decide your IQ. The lottery ticket you'd pick up would decide your weight, height, eye colour, hair colour, body type, your personality traits, your temperament, your wit, your sense of humour, what sort of health you'd have. Now, if you're listening to this, I'm guessing the ticket you drew when you were born wasn't too bad. The probability of drawing a ticket that has the favourable circumstances you're in right now is incredibly small. In fact, I read that the probability of you being born is basically zero. It's 10 followed by 2,685,000 zeros. In other words, you're a miracle. Now, I remember Warren Buffett talking about how important it is for us to be grateful. You've heard me say that as well. He said you should be grateful for the circumstances we're born into and for the generous ticket you were offered in life. He says that we should not take anything for granted or think that what we've now got is the product of something that we did. It's just that we drew a lucky ticket. He points out that all his skills in the art of allocating capital that's made him that multi-billionaire, he says they'd all be useless if he was born into poverty or if he was born into a civil war. Yet most of us are too quick to complain. We complain about the traffic, about the weather, about the ungrateful client or whoever that we sometimes have to deal with. We suffer from self-entitlement syndrome. Entitlement gets us nothing but heartache. It blinds us from the magic of gratitude. And most of all, it lets us off the hook, pushing us away from taking responsibility and, in fact, action, and towards apportioning blame, anger, self-pity. On the other hand, gratitude is just as valid a choice, except that gratitude makes us open to possibilities. It brings us closer to others. It makes us happier. So here's a trick, the message for today's mentorship moment. You're not grateful because you're happy. You're happy because you're grateful. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?